Well, good afternoon, everyone. Thank you for joining me here for this initial assessment of the 2021 Australian Government budget that was brought down by Josh Frydenberg, the Treasurer, last night. That's almost 6 months after the usual date of the budget in the second week of May, and unlike previous budgets in recent years, I wasn't able to be part of the Australian Broadcasting Commission's squad within the budget lockup, which would have given me access to the budget papers at about 1:30 in the afternoon, and then able to emerge at 7:30 having read all of them. It was a bit like the old days when, along with the general public, I couldn't get access to the budget papers until 7:30, and you'd be up till after midnight pouring through them, which is what I was last night. But anyway, as a result, we now have a presentation which I'm pleased to be able to share with you. Hopefully that's working. Just let me pick that one up, and that should now be working. So I'm going to bring that screen back here to my no, I can't do that. Yeah, okay, here we go. So let me begin this assessment of last night's federal budget with a view on the economy. Sometimes I put the view on the economy after the details of the budget, but clearly this one is shaped by the dramatic change in Australia's economic performance and outlook since the pandemic began in the middle of March. And it's therefore, I think, helpful in understanding what the budget is seeking to do and why it looks the way it does, to set the economic scene first. And as I think people participating today will be well aware, Australia is now in its first recession for almost 30 years, and its worst recession, at least measured by the contraction in real GDP, if not by the increase in employment, its worst recession since the Great Depression of the early 1930s. Treasury, in the budget papers issued last night, is forecasting a reasonably strong turnaround in economic activity, as you can see here. In terms of calendar years, which is not normally the way they forecast economic growth, they usually talk in terms of financial years ended 30 June. But in the text of Statement 2 in the budget papers, they said that they expected real GDP to increase by 4.25% in calendar 2021 after a 3.75% contraction in 2020. In terms of financial years, they're looking at a contraction of a bit over 1% in financial year 2021, followed by a strong rise of 4.75% in the financial year 2022. And they anticipate that that will generate a quite strong turnaround in employment growth for at least 2 years, with the unemployment rate peaking in 2021 at, well, at least in June sense, at just under 9%, and then beginning to fall. And they also think in the long-term projections that the inflation rate, which is currently well below the Reserve Bank's 2 to 3% target band, will pick up to the bottom end of that target band towards the end of the forward estimates period out there in 2023-24. And they also anticipate that we will see a gradual return to stronger rates of wages growth, though that's inevitably going to remain fairly soft for the near term. Unusually, this time the budget papers have provided detail of the quarterly forecasts underpinning the government's annual or financial year growth expectations, and they show that the Treasury is anticipating quite strong growth in the December quarter of this year and the March quarter of next year. Unlike some other forecasters, me included, they think we will have had slightly positive growth in the September quarter, notwithstanding the imposition of the lockdown in Victoria. But then they're anticipating that there'd be growth of 2.75% in the December quarter, followed by 2.5% in the March quarter, and then settling back to about 0.75 percentage point per quarter in the following 5 quarters. I've got my doubts about whether you can have quite as strong growth in the December and March quarters as Treasury is forecasting, in part because of the stepping down at the beginning of each of those quarters of the level of JobKeeper payment, initially from $1,500 a fortnight to $1,200 a fortnight, and then again down to $1,000 with a new payment of $700 a fortnight for people who were working part-time before the pandemic hit. They were in many cases, fortunate position of being paid more under JobKeeper than they had been while they were working part-time. And obviously that's an anomaly that the government was keen to correct. But I've got my doubts that economic growth can rebound quite as quickly as the Treasury is forecasting there. So for that reason, I suspect their forecast may be a little on the optimistic side. They're forecasting, as you can also see, the unemployment rate getting up to a peak of 8% in December and then falling back in the first half of 2021 and falling back further eventually to about 6% by 2022-23. That forecast may be tenable. It's obviously very sensitive to what happens to the labour force participation rate. That is, what happens to the people who've dropped out of the workforce rather than actively looking for work as a result of the pandemic. Of course, with the mutual obligation requirements associated with JobSeeker having been reinstated, some of those who did drop out of the workforce when they lost their jobs and weren't initially required actively to look for work in order to get JobSeeker payments are now having to do that. And that could push the participation rate up in such a way that it also pushes the unemployment rate up, even though employment has beginning to grow. But nonetheless, that's Treasury's forecasts for the unemployment rate. And given the way in which the Treasurer has framed 6% as a critical target for the framing of the government strategy, that will be something that will be important to monitor as months go by. This next chart provides a little bit more detail of the Treasury's GDP forecasts. In particular, you can see that the strong recovery which the government's forecasting for the 21-22 financial year is very much driven by an expectation of a strong rebound in household consumption of almost 6% in 2021-22 and a strong rebound in dwelling investment after 2 very significant years of decline. They're also anticipating a turnaround in business investment, although given the scale of the incentives for business investment that the budget's providing, that might seem like a fairly small response. Of course, there'll need to be a turnaround in private sector spending, whether it's by households or businesses in the 2021-22 financial year, because the government's anticipating a significant slowing in the rate of growth of public spending, as you can see from the middle of that chart. The other thing that's perhaps worth noting is that the government is assuming a significant decline in Australia's terms of trade. That's the ratio of the prices we get for our exports to the prices we pay for imports, in particular because they're again making the very conservative assumption that iron ore prices, that in recent months have been north of $120 a tonne, will have fallen to $55 a tonne by June 2021. I certainly think iron ore prices will fall, not least as Brazilian iron ore production that's been adversely affected both by tailings dam collapses and by some nasty outbreaks of the virus at some of Brazil's biggest mines as they come back on stream. But whether it falls to $55 or not, I guess, is something that remains to be seen. But that big fall in the terms of trade is one of the things that the Treasury expects will put an end to our recent run of current account surpluses, the first surpluses we've recorded on our external accounts since the mid-1970s, and that we'll be going back into current account deficit again, according to these forecasts. One other striking forecast in the budget documents that I think does have some potentially serious economic consequences is the substantial downward revisions to the forecasts of population growth. They never normally get much attention in the annual forecasts that are published in the budget papers, partly because they don't really change very much. But because of the shutdown of migration as a result of the closure of our international borders for the time being, along with what's apparently been some slowing in fertility in the birth rate. This document now forecasts that Australia's population growth will fall to zero in the 2021 financial year, which would be the lowest in over 100 years. The budget papers are forecasting that there'll actually be net outwards migration from Australia in the current financial year and the following one. And that has enormous implications, not only for our overall rate of growth, because our above average population growth has been an important contributor to our faster than average economic growth over the last 20 years and our apparent ability to avoid recession. Indeed, there's no doubt, as I've shown in some of my other charts that some of you will have seen, that if it hadn't been for our population growth rate being a full percentage point above the OECD average over the last 20 years, we wouldn't have been able to say that we'd gone 30 years without a recession. We would have had one in the conventional sense of that term in the global financial crisis year of 2008-9, and we would have come close to having had one in 2000, 2001, the year of the tech wreck as well. So having a substantially lower rate of population growth is going to be a significant drag on our economy's economic performance. And it will also weigh heavily on the housing sector because directly or indirectly, immigrants have been the principal source of growth in the underlying demand for housing over the last 25 years. If they hadn't been there, house prices almost certainly wouldn't have risen by as much as they've done over that period of time. And we wouldn't have needed to have built as many new dwellings as we have actually built over the last 4 or 5 years. So with the significant slowing in forecast population growth there, I'm a little bit skeptical of the forecast of a strong rebound in housing activity that I showed you in the previous chart that was one of the key contributors to the forecast pickup in overall economic growth in the 2021-22 financial years. That said, of course, there's no doubt that the economic performance would have been considerably worse, both over the last couple of quarters and prospectively over the next 2 years, if it wasn't for the extraordinary amount of fiscal policy support that the government has been providing through the budget. This chart here, which is drawn from a chart that was included in the budget papers, shows Treasury estimates saying that without those fiscal support measures, the economy might have contracted by 12% over the past 2 quarters rather than 7, and that by the middle of 2022, it could still have been 1.5% below where it was in the 4th quarter of 2019, rather than being, as the budget forecasts actually suggest, 2.75% above the level it was in the 4th quarter of 2019. Likewise, Treasury estimates that without the fiscal support that's been provided over the last couple of quarters and will continue to be provided over the next 2 or 3 fiscal years, the unemployment rate could have got up to almost 13% over the course of the next 6 months and still stayed well into double digits over the following year or so without those support measures. Again, those estimates are obviously partly conjectural, but I've got no doubt that the broad tenor of what they're saying is absolutely correct. Against that background, then, let me turn to look at the budget itself. And what's striking, of course, as everyone knows, is how dramatically the government's budget position has changed since the onset of the pandemic. This first chart here shows the forecasts that the Treasury provided last night of the so-called underlying cash balance. That's the most commonly used measure of the budget's bottom line these days. And by comparison, it shows the forecasts that the government presented in last December's mid-year Economic and Fiscal Outlook, or MyEFO as it's commonly called. In December last year, the Treasury was confidently predicting a return to budget surplus, the so-called back in black that Treasurer Frydenberg foreshadowed in his budget for 2019-20 that was brought down just before the federal election of last year. It was forecasting a return to budget surpluses over that period. It's now forecasting deficits totaling $566 billion over the 5 years to 2023-24, including a deficit of about $215 billion in the 2021 financial year. And in the same vein, whereas as recently as last December, The government was forecasting that net debt would peak at 392 billion in the June that's just gone by and then start to decline. This year's budget now predicts that net debt will be within cooey of $1 trillion by the end of the 4-year forward estimates period in 2023-24. The government has been right to recalibrate its fiscal strategy in response to these dramatically changed circumstances wrought by the pandemic. For the first 7 years of the coalition government's period in office, and indeed for the last 4 years of the Rudd-Gillard government's period in office under Treasurer Wayne Swan, the coalition has been seeking to return the budget to surplus by, as I quote from the 2017 budget paper here, maintaining strong fiscal discipline so that they can pay down debt. More recently, in his first budget, Josh Frydenberg said the government strategy was simply to achieve budget surpluses on average over the course of the economic cycle so that they could pay down debt. But this year's budget papers recognise that the pandemic has fundamentally reshaped the economic and fiscal outlook. And as the Treasurer said in a speech the Thursday before last, to maintain that strategy of running surpluses and paying down debt would be damaging to the economy and unrealistic. It would be making the same sort of mistake that Britain under David Cameron, the US under the Republicans who controlled Congress during most of Barack Obama's term, apart from the first 2 years, and of course most spectacularly in Greece after their financial crisis in 2012, to pursue surpluses in this situation and try to pay down debt would be repeating the mistakes that were made in all of those instances. Of course, Josh Frydenberg has had to cop a lot of flack from the opposition and from journalists who want him to explain why he's done such a pirouette from all of the demonising of debt and deficits that the coalition did, both when they were in opposition, and it was a Labor government that was running up deficits and debt, and subsequently since they've been in office. If it were possible for a Liberal Treasurer to quote Maynard Keynes, something which would be heresy for a coalition these days, then Josh Frydenberg could well have referred to what Maynard Keynes is supposed to have said, though there's no proof of it, when asked by someone as to why he changed his mind so often on a wide variety of issues, which he did. And Keynes is supposed to have said, when the facts change, I change my mind. What do you do? And there can't have been many occasions in the last century when the economic facts around the budget have changed by as much or as quickly as they have done over the last 6 months. So this year's budget introduces a new fiscal strategy, which consists of 2 phases. The first of which the Treasurer says will remain in place until the unemployment rate is, in his words, comfortably below 6%. And during that first phase, the government will allow the so-called automatic stabilisers to operate. That is, as the economy turns down and tax receipts fall or spending on benefits like JobSeeker rises, the government won't seek to offset that. And nor, of course, if the economy turns around, will it seek to offset the natural tendency of personal and business income tax payments to rise and unemployment benefits to fall. That's what the economists and budget people call automatic stabilisers. Second, the government says it'll continue to provide what it calls temporary, proportionate and targeted fiscal support to the private sector, to households and businesses. And he says they'll continue to pursue structural reforms which position the economy for the jobs of the future. Once the unemployment rate is, in his words, comfortably below 6%, the government will then move to the second phase of its fiscal strategy, which will also comprise 3 elements. Again, structural reforms that increase our economy's potential, a shift from providing targeted and temporary support to one which they describe as stabilising gross and net debt, which of course in turn means basically returning the budget to balance and then running budget surpluses, because although, as they argue in part of the budget papers, if interest rates are as low as they currently are, you don't need to run budget surpluses in order to reduce the ratio of debt to GDP, as long as the growth rate of nominal GDP is higher than the interest rate on government debt, you can achieve that outcome in a low interest rate environment. But if they want to reduce the dollar value of debt, then they need to run budget surpluses in order to do that, which is, I think, what the Treasurer means when he talks about the hard work of rebuilding our fiscal buffers, so that should something like this happen again at some point in the future, which it inevitably will, even if not on the same scale, the government is in a position to respond to that in much the same way, broadly speaking, as they have done to this particular downturn. If we look at in more detail what's happened to the budget bottom line since the mid-year economic and fiscal outlook was published last December, we can see that, roughly speaking, just under half of the deterioration in the budget balance has been the result of policy decisions. That is, conscious decisions by the government to spend money or to reduce taxes, and slightly more than half has been due to what the budget papers quaintly refer to as parameter variations, that is to say, changes in the economic forecasts and assumptions and other working assumptions, such as the take-up rate of the age pension, on which forecasts of revenues and expenses inevitably depend. So it's roughly half due to the economy and half due to conscious decisions the government has made in response to the change in the economy or to the health crisis that have seen that massive turnaround in the budget position over the 4 or 5 years that I've depicted here. It's perhaps also worth noting, in terms of assessing last night's budget, that 80% of the policy decisions that I've shown there in the pink columns in that chart were taken in the first 3 months or so of the pandemic. That is, they were taken from late March, when the crisis first broke, through to the July economic and fiscal update statement, in which the government announced the extension of the JobKeeper payment and then had to extend it again because of the onset of the second wave in Victoria. So by contrast, the policy decisions announced last night in the budget only amount to $62 billion of impact on the budget bottom line over the 4 years to 2023-24. Now, that's of course still a lot of money. I'm not pretending otherwise, but it's considerably smaller than what the government has judged it necessary to do over the first 3 or 4 years of the pandemic, the first 3 or 4 months, I should say, of the pandemic. And it's perhaps also worth noting that a very substantial proportion, 55%, of the total of policy decisions, 313 billion, that account for half the deterioration in the budget over the 5 years to 2023-24. Roughly 55% of that occurs in the current financial year, 2021. That's what the government means by saying that the measures it's introduced are temporary, and they say that's by way of contrast with the permanent increases in the spending base that formed a significant part of the fiscal response of the Rudd-Gillard government to the global financial crisis of 2008-09. This table provides more detail than I'm going to go into of the measures that have been taken since my EFO of 2018-19. But while I'll leave those there for you to look at later on, this pie chart probably gives a clearer insight into what the government's been doing. It just goes to highlight how the JobKeeper program, one single program, has accounted for 35% of all of the cost of the policy decisions that have been introduced in response to COVID-19 or its economic consequences. And then business tax cuts and incentives, including the cash flow support for small businesses, the instant asset write-offs that were introduced for small businesses at the beginning of the pandemic and have been extended last night to virtually all businesses except the major banks. That's another almost a quarter of the policy decisions that have been introduced. And then there have been other measures that are worth noting, such as the income support to people who lose their jobs, the elevated level of job seeker payments and the coronavirus supplement. There's the personal tax cuts brought forward, which I'll go into in a bit more detail in a moment. The additional infrastructure spending that's been brought forward both prior to last night and again in last night's budget. The spending that the government has had to undertake in order to strengthen the capacity of Australia's hospital system and more broadly the health system to cope with the challenges posed by COVID-19. And then there's a whole raft of other measures that in total don't add up to a huge amount. So just to underscore how substantial the JobKeeper program in particular has been, and the business tax incentives as were announced in last night's budget have been. As I've just indicated, the budget announcements last night were mainly about incentives for business to hire or undertake capital expenditures, and the bringing forward of the personal income tax cuts that were originally scheduled to commence on the 1st of July 2022. The biggest single measure in last night's budget was the widening of the so-called instant asset write-off for small business that was originally introduced by Joe Hockey 5 years ago and extended in the early days of the pandemic as one of the measures that was in the first of the packages that the government introduced. That's now going to be available to all businesses with a turnover of less than $5 billion, which is apparently about 99% of them. And it means that anything that they buy that is a depreciable asset for tax purposes, they'll be able to write off against their taxable income immediately. And that's going to entail a cost to revenue of about $27 billion over 4 years. Of course, there's a longer term clawback from that because companies and businesses who take investment decisions as a result of this incentive won't be able to claim depreciation against profits in subsequent years, but that's of course a fair way down the track. Companies with a turnover of up to $5 billion will also be able to claim refunds of tax paid in or after the 2018-19 financial year if they incur tax losses during last financial year, this one or the following one, as a way of generating some additional cash for themselves at a cost of revenue of about $5 billion over the 4 years to 2023-24. In addition to these incentives to undertake capital investment, there are also two big wage subsidy programs for business that are designed to encourage them to hire people. There's the so-called JobMaker hiring credit that provides $4 billion over 4 years to provide a wage subsidy to employers who hire people aged 16 to 35 who've previously been on job seeker or youth allowance in at least one of the 3 months before they're hired. This subsidy is going to be $200 a week for people aged between 16 and 29, and $100 a week for people aged between 30 and 35. Now, obviously, one potential risk of a scheme like this would have been if employers were to see it as an opportunity to get rid of older workers and substitute them with younger ones who are not only cheaper, but would have their wages subsidised under a scheme like this. The government seems to have put in place an adequate safeguard for that by stipulating that employers only qualify for this subsidy if their overall level of employment and their payroll increase as a result of taking people on. So hopefully that will prevent what would otherwise have been an unintended and unpleasant side effect of a scheme like this. The other incentive the government's provided is $1.2 billion for a wages subsidy of up to $7,000 per quarter, or 50%, for new apprentices and trainees taken on between now and the end of October. For individuals, the largest measure was one that the Treasurer had been flagging for some weeks leading up to the budget, bringing forward the tax cuts that were previously legislated to take effect from the 1st of July 22. The government's obviously been sensitive to suggestions that these tax cuts are skewed towards middle and upper income earners, because they haven't brought forward the tax cuts, the third tranche that were due to come in and which now will still come in on the 1st of July 2024, tax cuts which are much more skewed to higher income earners than these ones are. And they've also, in order to counter that perception that these tax cuts are skewed towards middle and upper income earners, extended the low and middle income tax offset, which is referred to in bureaucratic circles as the Lamington. They've extended that artifice, which was the vehicle through which they delivered the first tranche of tax cuts that came through in the September quarter of last year. They've extended that for another year in order to try and address the perception that this round of early tax cuts primarily benefits middle and higher income earners. And while it's true that this measure will put a lot of money into people's pockets, as the Treasurer said, there's no argument about that, it certainly will. There's no guarantee that the people into whose pockets he puts it will spend it, as opposed to saving some of it, for example, in the form of increased voluntary super contributions, or using it to pay down debt. I say that especially given the uncertainties over the end of JobKeeper at the end of March next year. People who are currently being supported by JobSeeker and who know that that program is going to come to an end unless the government decides to extend it on the 31st of March next year may well want to save some of that money in case they need it. Or people who've currently taken advantage of the mortgage repayment holiday but know that when that comes to an end, they'll face either higher repayments or a longer repayment period. They may want to put some aside for that, or possibly to pay down some of their mortgage debt earlier, or put it in an offset account rather than spend it. There's some other additional spending measures as well, including almost $8.75 billion under one program or another for grants to the states for infrastructure spending, including road safety projects. There's $1.5 billion for the so-called modern manufacturing strategy. There's $2 billion for aged care, and I'm sure there'll be more for that sector after the Royal Commissions have reported. But most of those had been detailed before the budget or leaked to the government's favourite newspapers over the previous weekend. So I won't go into too much detail about those here. But I do just want to draw to your attention two reasons why I'm a little uncertain as to whether the incentives the budget has provided to households and businesses will be as effective as the government has assumed. In August, as part of the regular surveys the Stats Bureau has been doing of how businesses are faring during the pandemic, they asked businesses what were the major factors affecting their investment decisions. And you can see from this chart that the single biggest factor weighing on businesses as they decided whether or not to undertake capital expenditures was uncertainty about the future state of the economy. Almost 60% of businesses said that was a factor weighing on their investment decisions. Whereas the changes made to the instant asset write-off by the government in March this year were a relatively minor factor. And even other government support measures were of considerably less importance to businesses in deciding whether to undertake capital expenditures than the future state of the economy and the expected state of future customer demand. So although these incentives have undoubtedly worked in the past, they have stimulated increased capital expenditure, although I would note in passing that most of the things that it stimulates spending on, like utilities and laptops and coffee machines and the like, they're almost all imported. So while the retailer of those products, the motor vehicle dealer, takes a clip on the way through, in many ways these measures provide an immediate stimulus to the economy of Thailand or China or Germany or somewhere like that, rather than to the Australian economy. But as I say, there are reasons why, despite the fact that these measures have worked in the past, they may be less guaranteed to work in the circumstances in which we currently find ourselves. And then if we look at the tax cuts, here's a graph of the saving rate, and you can see that the tax cuts which were directed to lower income earners in the second half of last year were for the most part saved rather than spent. And of course, all the cash that governments have been shoveling at households through JobKeeper and JobSeeker and in other ways during the pandemic have also mostly been saved, partly, of course, because restrictions prevented people from spending it in the way that they could or would have done. So I'm not suggesting the saving rate's going to stay up at 20% anytime for any length of time. But there's still, I think, a chance that the tax cuts will be saved or used to pay down debt rather than spent as freely as the government would have liked. And that's why I'd proposed in recent weeks that instead of bringing the tax cuts forward, the government could have used the same amount of money to give every household in the country a voucher, which would have had the value of somewhere between $1,500 and $2,000 each. voucher which would have expired if it wasn't spent by, say, the 30th of June 22, which could be sold to someone else, inevitably for less than its face value, if the person who had it couldn't use it. But otherwise, the voucher could be spent only in areas of the economy that were subject to ongoing restrictions, like tourism and the arts, could be spent in areas that would help people get back to work, like childcare or training and retraining, could, for example, in the case of pensioners and others for whom childcare or job retraining isn't really a priority, used to pay bills such as utilities or council rates. Or given the looming downturn in housing activity, perhaps the vouchers could have been used for home renovations or put towards the deposit on a first home. Either way, or in any way, doing it that way would A, have guaranteed that the money would have been spent, B, guaranteed that it would have been spent when you wanted to spend it, that is now, and between now and say the middle of 22. And third, that would have been spent in areas that most needed it or were most likely to contribute to an economic recovery. But the government says it doesn't like to tell people how to spend their money, even though one of the intellectual champions of vouchers as a policy tool was Milton Friedman, someone to whom Margaret Thatcher and Ronald Reagan looked for inspiration for economic ideas. And of course, as you'll remember, Josh Frydenberg said a few weeks ago before the Prime Minister slapped him down that he'd be looking for inspiration from Thatcher and Reagan as he framed his budget. Well, I did suggest it, but unfortunately, like a lot of things I suggest, it wasn't really taken up. What wasn't in the budget, by contrast with what is? Well, there was no suggestion of any extension to the JobKeeper scheme beyond the currently scheduled expiry date of the 31st of March. That, of course, doesn't preclude the possibility that the government could extend it again if, for example, Victoria or some other state had another outbreak like Victoria has just had, or if for some other reason the unemployment rate were to be much higher in the early part of next year than the budget assumes. I think it would be inevitable in those circumstances that the government wouldn't allow JobKeeper just to terminate completely and abruptly. They would probably extend it. But there's time to make that decision, and they didn't have to include it in the budget if it turned out not to be necessary. There was no mention of any adjustment to the rate of job seeker payment, which, as things stand, is set to revert to the old New Start level of $40 a day on the 31st of December. The government said that in relation to that payment, they'll make some announcement later after they've had the opportunity to assess how many people and to what extent they're able to get back to work. I'm not sure this is a completely convincing explanation. I mean, this argument about the appropriate level of the New Start allowance, job seeker it's now called, has been around for a long time. Historically, unemployment benefits, as they were then called, were around about 75 to 80% of the single age pension. But because they've been frozen, except for adjustments to inflation, whereas the age pension has risen in line with male average weekly ordinary time earnings, plus some other increases that have occurred at different times over the last 25 years, the unemployment benefit's now down to less than 66% of the level of the single age pension. And it's not just the usual suspects on the left of the political spectrum or representing community groups that are arguing that this payment ought to increase. The Business Council says the same thing. And even John Howard, who was one of the prime ministers responsible for the decline in the real value of the job seeker payment, also thinks that this ought to be increased. So why it wasn't in the budget, I don't know, someone else would have to say. There was nothing in the budget for childcare, even though it's widely recognised that the cost and availability of childcare is a major deterrent to increases in labour force participation by women, which is lower in Australia for women of childbearing and caring age than it is in comparable countries like New Zealand, Canada and the United Kingdom. Beyond funding the previously announced extension of the terminated at the national level childcare arrangements for Victoria, there was nothing in the budget about childcare at all. Nor was there anything in the budget for social housing, even though it's almost unanimously agreed among economists that spending on social housing is a particularly effective form of fiscal stimulus, partly because it can be spread widely across geographical areas, partly because it's labour intensive, partly because it's not import intensive, and of course because it meets a genuine unmet need within the Australian social safety net. But apart from providing that the National Housing Finance and Investment Corporation can raise an additional $1 billion of bonds from superannuation funds to invest in affordable housing, something which doesn't impact the budget bottom line. There was nothing in the budget for social housing at all. And apart from the previously announced changes to the insolvency and responsible lending or credit laws, there was nothing really in the budget by way of either new policy or funding for productivity enhancing structural reforms, unless you consider the announcements that the government made about superannuation funds as a productivity enhancing reform, which I don't really think it is. I think it's more designed to assuage the government's small army of backbench critics of industry super funds than it is to classify that as a productivity enhancing reform. As a result of all the things in the budget, the deficit is forecast to widen to $214 billion in the current financial year. That's 11% of GDP, the biggest since 1944-45. And moreover, the budget papers are saying that even by the second half of the 2020s, the budget deficit is, on unchanged policies, still going to be running at around $50 billion per annum. Of course, before we get to that point, if all else goes according to the government's forecasts and plans, the unemployment rate will have fallen to comfortably below 6%, and the government will then have embarked on the second phase of the fiscal strategy I outlined earlier, under which it will be devoting its attention to budget repair and getting the budget back to a more sustainable over the long-term position. So if all goes to the government's plans, probably they won't be running budget deficits of 50 billion per annum in the second half of the 20s. But at the moment, as the way things stand, that's what the government is forecasting. And of course, as a result of running such a long series of large budget deficits, they're going to be racking up a lot more debt. The budget papers indicate that the government's gross debt will top $1 trillion during the 2021-22 financial year and will go on to reach almost $1.75 trillion by the end of the decade. As a percentage of GDP, gross debt is going to increase to about 45 to 50% of GDP by the end of the decade. That will actually still be less than gross debt as a percentage of GDP was from the time of Federation until the late 1950s. And during that period, of course, not only did the federal government finance 2 world wars, or our participation in 2 world wars with borrowed money, but from 1929 until 1989, the federal government also used to borrow on behalf of the state governments, who in the first 28 years or so of Australia's existence as an independent nation proved they couldn't be trusted with free access to the capital markets of London, as they then were, although more recently, since Paul Keating undid that loan council agreement of the late 1920s, the states have been borrowing in their own right, and they seem to have been borrowing more responsibly than they did in the first 25 or so years of Australia's existence as an independent nation. Despite those seemingly mind-boggling or eye-watering numbers with regard to deficits and debt, the government's certainly not having any difficulty raising the money it needs to finance them. Since the 30th of March, the Australian Office of Financial Management, which runs the government's debt portfolio, has borrowed $207 billion by way of Treasury bonds, but they actually could have borrowed more than $700 billion if they'd wanted to at interest rates that were barely 0.05 of a percentage point above the interest rates they actually agreed to pay. In other words, the bond markets, investors from around the world and Australia, literally falling all over themselves to lend money to the government at current interest rates. They don't need the Reserve Bank to print money in order to buy them directly from the from the government, as Paul Keating so fatuously suggested a couple of weeks ago. I mean, that's a bit rich coming from someone who used to boast that he had the Reserve Bank governor in his pocket, along with everybody else that was important in the economic decision-making process, and who also at one stage said that monetary policy was simply a matter of picking up the telephone to the governor of the bank and telling him what to do with interest rates. There's no need for the Reserve Bank to engage in money printing here in Australia at the moment, when the government can borrow so readily at record low interest rates as it's been able to do. Net debt, that is gross debt less the government's financial assets, including those in the Future Fund, its loans to states, and student debt will reach a record high of more than 40% of GDP as a result of all the borrowing that the government is proposing to do. But again, we shouldn't be unduly worried about that. By international standards, Australia's net debt, even at over 40% of GDP, looks pretty modest by comparison with, in particular, Japan, where it's over 150%, or Italy, where it's 130%. But even in the United States or the UK, public net debt as a percentage of GDP is more than double what it is in Australia. And those numbers, for the most part, come from forecasts that the International Monetary Fund made in April this year. And when it releases revised forecasts, which it's going to do next week as part of the IMF's semi-annual World Economic Outlook publication, all of those numbers for those other countries are going to be revised quite significantly upwards. So by international standards, Australia's level of net debt is going to look pretty small. And that's, of course, one of the reasons why bond investors are very willing to lend to the Australian government, because by comparison with other countries such as I've shown here, the Australian government continues to be a very good credit risk. Moreover, what really matters from a sustainability perspective when it comes to debt is not the level of debt itself, but the capacity of the Australian government to service it. And because interest rates are so low, record low, the government's gross interest bill as a proportion of GDP will be less over the next 4 years than it was in 2017-18 or 2018-19, but importantly, a lot less than it was in the 1970s, 80s, and 1990s. Or to use a different chart that was provided, a different series that was provided in the back of the budget papers for the first time, in real terms, net interest payments per head of population are going to be lower in the years ahead than they were between, for example, 1993-94 and 1999-2000, and significantly lower than they were in the 1980s and 1990s, when, of course, bond yields were more often than not upwards of 10%, compared with the roughly 1% or less that the government is paying on longer-term bonds at the moment. So what's my overall assessment of the budget after all of that? Well, the best word I could come up with was appropriate for the circumstances. I was tempted to say that this was the budget that Australia had to have, echoing Paul Keating's memorable comment about the recession we supposedly had to have in the early 1990s. And that's probably not a bad moniker either. But it's a budget that, in its broad dimensions, is an appropriate response to the circumstances in which the government and in which all Australians have now found ourselves. But it is one that's heavily reliant on individuals and businesses responding positively to the incentives which it contains. It's appropriate that during the worst recession since the Great Depression, the government should be running the highest budget deficit as a proportion of GDP since the end of the Second World War. If they hadn't done that, if they hadn't been prepared to do it for the next couple of years, almost certainly we would have had a deeper and longer recession than we've had, and we would be looking at a slower and more vulnerable recovery than the one that we're looking at. And as I've said, the government isn't having any difficulty financing this record deficit, and it won't have any difficulty servicing the debt which results from these deficits over the years ahead. But the budget strategy is heavily reliant on households spending their tax cuts and businesses responding positively to the incentives to invest and hire. Whereas, as I've tried to argue in this presentation, both theory and recent evidence suggests that a significant proportion of the tax cuts that individuals are going to get would be saved, and that it would have been more effective in terms of bang for the buck if the government had provided households with time-limited tradable vouchers of equivalent value to the revenue they'll forego by bringing the tax cuts forward by 2 years. Likewise, although history suggests that businesses will respond positively to the investment incentives that the budget includes, and I would think common sense suggests they'll respond positively to the incentives to hire, it may be that uncertainty on the part of business about the outlook for the economy more broadly, or about demand for their specific products, is such that they're reluctant to take up those incentives, especially if they have to borrow money in order to fund the capital expenditures that these incentives are designed to incentivate. The government has, by contrast, largely eschewed additional direct spending, in contrast, of course, to what it's done through JobKeeper in particular over the past 6 months. The additional infrastructure spend in the budget is actually quite small. It's only about $9 billion that's being provided to the states for bringing forward shovel-ready projects, or being spent by the federal government through its own agencies on projects like the NBN or the Inland Railway. Although it's interesting as an aside to note that although the budget does provide additional funds for the Inland Rail Corporation, that's the one that's going from Melbourne to Brisbane and passing through, just by coincidence, every marginal National Party electorate that's in between them, picking up, as I sometimes say, votes rather than freight. They don't actually tell you how much money they're giving to the National Rail Corporation because that is supposedly commercial in confidence. Can't see why it should be commercial in confidence, given that it's not as if the Rail Track Corporation or Inland Rail Corporation faces a lot of competition to do what it's doing. But nonetheless, apparently we voters and analysts aren't allowed to know exactly how much they're getting. The government has rejected advice from all quarters to increase spending on things like social housing, as I've mentioned. And finally, the economic assumptions and forecasts on which the budget is based might be a little optimistic in some places, particularly as regards the strength of the upturn in the next 2 quarters, and possibly with regard to the strength of the turnaround in housing activity that forecasts, notwithstanding the substantial shortfall in population growth that it also forecasts. The government does note in the budget papers that if there are more outbreaks of the virus that require a repeat of the sort of shutdowns that Victorians have endured, or if a vaccine isn't widely available and fully in place by late 2021, economic growth could be materially weaker than the budget has forecast, and in those circumstances, almost certainly the deficit would be bigger and the level of public debt higher than I've just been outlining here. And of course, the same thing will result if households and businesses don't respond as expected to the incentives that the budget has provided. What could go wrong? What could bring about those worse than expected scenarios? Well, obviously, as any Victorian could tell you, if there were to be another wave of infections requiring another comprehensive lockdown, even if it were only in one state, that would undermine the forecast economic recovery and require additional fiscal responses from the government. In the same way, if contrary to the assumption that they've made, and I don't blame them for making this assumption, they had to make an assumption one way or the other, and whichever assumption they made would be a big one, liable to being wrong. But if a vaccine isn't widely available by late next year, or if there is one but it isn't effective, or if a large proportion of the population refuse to take it, which I guess you can't rule out, then the economic recovery would be delayed, set back, or both. Again, I've already mentioned, but it is an important point, the budget strategy is heavily dependent on households and businesses responding positively to the incentives which the budget contains. And there's obviously a non-trivial possibility supported by recent experience that households will save or pay down debt with the money they get from the bringing forward of income tax cuts rather than spending it. And although, as I say, the recent history about investment allowances and incentives is kinder to the assumptions in the budget, given the uncertain climate that most businesses are facing, it wouldn't be entirely surprising if those incentives weren't as successful as they have been in the past. There might still be some risk associated with the termination of the JobKeeper payment and the stepping down in the level of job seeker payments to people without jobs. So it will be important to monitor the impact of the interim step down in JobKeeper payments, the first of which came into effect at the end of last month, and the next one will come into effect at the beginning of January. We could look, for example, to the release of the ABS's weekly payroll jobs series for the first half of October, that's going to be released in early November, to see whether that risk is significant or relatively small. There might also, and finally, be some medium-term risks of the government reverting to its previous budget strategy of trying to get the budget back into surplus and then pay down debt if they start that prematurely. The Treasurer has said that they won't begin to think about that until the unemployment rate is comfortably under 6%, which on their projections won't be until 2023-24. But there are still a couple of questions around that. First of all, what does comfortably mean? Does it mean a percentage point, half a percentage point, 2 percentage points? Don't know, because the budget papers don't tell us that. But you could also ask, why 6%? When the long-standing belief of the government and the Treasury and the Reserve Bank and most private sector economists has been that the so-called non-accelerating inflation rate of unemployment, or NERU, the rate of unemployment at which inflation starts to accelerate, is 5%. And indeed, because as unemployment had come down close to 5%, there'd been no evidence that wages growth was beginning to accelerate. The Reserve Bank and others had started to wonder whether the NERU might actually not be 4.5% or even lower. And we've seen something similar in the United States, where it had long been thought that the NERU was around 5%. But then before the pandemic, for some time, the unemployment rate had fallen to 4%, and then for almost a year had been in the high threes, the lowest since the late 1960s. And it wasn't until then that wages growth in the US, which had been stagnating for years, especially at the bottom end, had begun to accelerate decently. So the Federal Reserve, for its part, has recently decided that it's not going to, in the famous words of former Chairman William McChesney Martin, take the punch bowl away just before the party gets started. They're actually going to wait to see the whites of inflation's eyes before they begin to start raising America's version of the cash rate. And it makes you wonder whether it might not be better for the federal government to wait until the unemployment rate is, say, less than 5% before they start tightening fiscal policy, as they would need to do to get the budget back into surplus and start the process of paying down debt, if that's what they want to do. That, ladies and gentlemen, is my take on last night's federal budget. Thank you very much for listening to all of that. And now I'd like to throw it open. If there are any questions, I think people can either use the chat function or raise their hand or something like that. And if there are any questions, well, I'd certainly be delighted to do my best to answer them. If someone wants to type a question into the chat function, and then I can read that out. If there aren't any questions, or even if there are, while they're coming through, I should perhaps mention that towards the end of this month, I forget the exact date, but it's, I think, the last Wednesday in October, I'm going to be doing a preview here of the upcoming US election. I guess it now seems more likely than not that there will be a change of presidency on the 20th of January as a result of the election that's to be held on the 3rd of November, unless the outgoing incumbent finds a way to tie it up in the Supreme Court and extend his term in the same way that his mates Vladimir Putin and Xi Jinping and Viktor Orban and Erdogan in Turkey have been able to do. He likes those sort of people, but I suspect that when we get round to the last Wednesday in October, we'll have a clearer picture one way or the other of who's likely to win not only the presidential election, but also whether the Democrats will make a clean sweep of Congress. So it might be timely to do something that not many people do seem to be doing at the moment, which is to look at what sort of policies might result from a Biden administration with a Democratic majority in both houses of the United States Congress. Almost certainly we would see some increase in the corporate tax rate. I'd like to think we'd see some change in US trade policy, although the Democrats are in different ways, but almost as protectionist as the Republicans are. One of the few things in American politics in which there's common ground between the Republicans and the Democrats these days seems to be the desire to disentangle or disengage the US economy from China. That means something rather different for the US, which runs a big deficit with China, from what it does for Australia, which is one of the few advanced economies that runs a trade surplus with China. But there are those and various other issues to do with financial regulation, climate change policy, and the like that I'll want to explore at the webinar, which will be on the 28th of October at 9 p.m. Australian time, Rati is reminding me. Here's a question here asking about my view about the likely path of interest rates given this budget. I think the Reserve Bank has been giving pretty clear signals in recent weeks that it wants to do a bit more on the monetary policy front. The minutes of the last 3 board meetings have related that the board has been actively considering what more it could do in that direction. And both Phil Lowe, the governor, and Guy Debelle, the deputy governor, have made speeches in which they've canvassed options for doing more. They've ruled some of them, such as negative interest rates and printing money, out, and wisely so in my view. But there are three options in particular that they've left open. One is reducing the target for the official cash rate from 0.25, where it's been since March, to 0.10. The cash rate has actually been trading at about 0.13 for most of the last 4 or 5 months. So from one perspective, reducing the target to 0.1 wouldn't make that much of a difference, but it might encourage the banks to lower their lending rates a little bit more. The second thing that they flagged is lowering their target for the 3-year bond rate that they've been pursuing through their version of quantitative easing, the one that's modelled on the Bank of Japan's yield curve control, whereby they've been trying to keep the 3-year bond yield at 0.25. They could lower that target to 0.10, and that would serve as a signal that they intend to keep the cash rate at 0.10 until, in their phrase, Australia is sustainably on the path back to full employment, and the inflation rate is clearly headed back to within the 2 to 3% target band. And the third thing they could do is to lower the interest rate on their term funding facility. That's a facility they set up in March to make loans fixed for 3 years at what's currently 0.25% per annum to banks and other lenders, with a view to them on lending it particularly to small and medium enterprises. That facility started out with 90 billion. Banks have now taken up about 82 billion of funding through that, most of it in the last 3 or 4 weeks. And the amount that's now available, the funding envelope, is north of 150 billion. So they could reduce the interest rate on that. I had thought it was possible they might have done that yesterday, because the Reserve Bank's practice has been that when they've decided a rate cut or some other monetary policy measure is necessary, they usually do it at the first available opportunity. But perhaps they thought that they didn't want to get in the way of the optics around the federal budget, given how important it was. Or perhaps alternatively, they thought if they did ease monetary policy yesterday, no one would have noticed because of all the attention that would have been devoted to the budget. So perhaps they're holding it off until Melbourne Cup Day. I'm assuming that there actually will be a Melbourne Cup on Melbourne Cup Day, although perhaps no one will be allowed to go. But they normally issue revised economic forecasts in the middle month of each quarter, and that's quite often a month in which they'll also make an adjustment to monetary policy. So that could be the rationale as well. But to answer the question fully, I think there will be a further reduction in official interest rates. It's not sure. I don't think that they can go much further than that without really going down the very unorthodox path of negative interest rates or printing money in order to buy bonds directly from the government, both of which have their advocates in Australia, but I think neither of them would be helpful, could potentially be counterproductive over the longer term, and perhaps more to the point than anything else, aren't necessary in current circumstances where the government's having absolutely no difficulty funding its deficit at very low interest rates. Can I again say thank you very much for being here for these webinars. It's a bit of an experiment on our part to see how well they work. Thank you, Rati Lahur, my website manager, who's over in Germany and who's got up earlier than usual in order to help make this happen. Rati's the person who's responsible for the website looking as good as it does and as up to date as it does. So thank you again, Rati, for that. Please tell your friends and colleagues about the website and about the webinars if you think they've been of value to you. And I hope that we'll see you and more of your friends and colleagues at the next one on the 28th of October at 9 p.m. Australian time. Thanks very much for being here, and good afternoon.